across to the RBI governor who's addressing the press.
Certain serious deficiencies, it is pointed out to the institutions. We give them enough time to take the corrective measures. In many cases, the corrective measures are taken and we don't take any action at all. In fact, the number of cases where we found deficiencies and where we did not take any action because the corrective actions were taken and whatever were the regulators' expectations or, regulators' expectations, they were complied with. So the number of cases where we did not take action is actually much larger. Now, that doesn't mean that there is something fundamentally wrong with our NBFC sector or the financial sector. On the whole, the financial sector, the NBFC sector at the system level remains very robust. It's only in a few cases where we do not see adequate action being taken or we do not see action being taken in time and in sufficient, is not up to our expectations or it is getting delayed. Only in those cases we take action. And the detailed reasons for the action is always shared with the individual company. It's not as if they are kept in the dark. Action is preceded by bilateral discussion with them, bilateral engagement with them. They know what are the concerns of the regulator. When we take the action, we also share with them formally the reasons as to why we have taken the action. And we point out that these are the areas where we find deficiencies and we would expect you to act. Our action is not punitive. Our action is corrective. You would have seen in a number of cases where we have taken action after 6 months or 8 months when, the compliance is completed. Its compliance is 100% or near 100%. And if we are satisfied that the rest of the compliances will be done in the next few weeks or so, we withdraw the restrictions. It is good for the individual institution itself, for its sustainability. It is good for the financial sector, and above everything, it is good for the consumer. All actions are taken in the consumer's interest. And communication, Shailesh Dovalji talked about RBI's communication. You would have seen that the press note which we issue these days when action is taken are fairly explicit. They point out why the action has been taken. So our effort has been to be far more consultative, direct engagement, transparent communication, and measured action. It's not abrupt, it's not arbitrary. You may say I'm being defensive. I'm not, because I think it is necessary in a gathering, such an informed and well-informed gathering like this, where there are so many, I think all the participants are from the BFSI sector. I think it was very important for me to explain the things in their totality. Sorry for that very long answer, but I think it was necessary to, put things in the right perspective. Thank you.
Thank you. Thank you, sir. It's very, I think all of us should feel happy that consumer protection also has come on the RBI radar. And one interesting part is this: you are very democratic in your approach. You don't care about the stature of the entity, be it NBFC, banks, payments bank. Whenever you find something is wrong, you flag off without caring for how big or how small is the entity. So, sir, let's come back from non-banking to banking. 10 years back, 2014, banks were in deep trouble, very high NPA, so on and so forth. And then the AQR has come, asset quality review, banks have come up clean, and as we speak, they are in pretty good health. But still, you continue to show your concern about credit uptake. You think that banking sector is a little overdoing on the credit front. It seems that if we are looking for a 7%, 7.5%, 8% growth, banks should be in the business of giving credit. But you continuously warn them. What is happening there?
You see, our action and approach is very nuanced. It's not so much that, the credit growth is high or low. We don't have a view on that, whether the credit growth should be this much or the credit growth is high or low. It depends on the situation, the conditions prevailing in each bank. There are opportunities to lend. Naturally, the banks will lend. After COVID, there was a spurt in consumer, demand for retail loans, etc., naturally the banks and the other lenders will lend where there is an opportunity. There are a couple of things which we always try to monitor. Number one, what is the underwriting standard which the bank or the other lender, the NBFC, what are the underwriting standards? In the banking sector, by and large, I feel that the underwriting standards today in India, there has been considerable amount of improvement. In the NBFC sector also there has been improvement, but there still we find a few outliers where we feel that the underwriting standards need to be made more robust. So again, at the system level, at the system level there is no issue, let me be very clear. So we always look at what kind of underwriting standards are being followed, whether the underwriting standards are being diluted only to push credit. So that is number one. Second thing is we also look at the liability side with regard to each and every, you are talking about banks, so I will talk about banks. About each and every banking entity, we look about the liability side also, where the deposits are growing proportionately with their credit growth, because there has to be some correlation between them. And we have not hard-coded that this shall be the CD ratio for the banks. RBI has not prescribed any, it's not, there is no hard coding. But this is something which I think every bank, every banker understands, that the CD ratio cannot be, completely skewed. So therefore, we look at, in the liability side, what is the composition of the liability? Are these short-term borrowings to sustain a medium-term, a loan which has a life of, let's say, 5 years or 3 years? You raise money, a certificate of deposit, and based on that, which has a life of up to, let's say, 1 year, and based on that, you are giving credit. And to what extent you are giving credit for 3 years or 5 years? So we see whether the liability and the balance side, the components and the structure of liability and the structure of the asset side are whether they are well balanced. So we look at the deposits. Now I mentioned that we have not hard coded any CD ratio, but I think the banks are today far more aware about the requirements on this. And CD ratio at the system level today is around 80%. Which is, I think, a considerable amount of improvement over what it was a few months ago. But there are, few, just you can count them in, some outliers here and there, where also we see that there is improvement. So therefore, we look at two broad factors when it comes to credit growth. One is the underwriting standards. And in underwriting standards, we also see whether the institution, not so much in the case of banks, but in the case of NBFCs, whether it has got the bandwidth to sustain that kind of, high credit growth, and whether in the process the, underwriting standards or the due diligence that is expected of them is getting diluted. So our